new fashion wear for men.
Thanks for tuning in. You're watching Countdown on Bloomberg Quint, India's first digital live streaming business news service. These are the top headlines that we're tracking at this hour. Markets consolidate after a strong surge. Nifty trades around the 10,550 mark. Most sectoral indices barring autos decline in trade, and PSU banks are the biggest laggard for the day. Monet Ispat's creditors may have approved JSW Aeon Capital's bid for the company despite having to take a 70% cut on their outstanding amount, and that's a Bloomberg Quint exclusive. Ambuja Cement is the worst performer on the Nifty after it put its merger plans with ACC on hold. The Finance Ministry sets a 15-day deadline for PSU banks to identify the gaps in the system and make suggestions on how to plug them. And Punjab National Bank falls to a 20-month low after it says that the fraud amount in the Nirav Modi case may be higher than estimated.
Well, it's banks which is spoiling the party, if you will, in the session today. The large caps haven't corrected more from where they were, but the Nifty banks certainly at the lowest point of the day. So the Nifty is about 1/3 of a percent, and it's been like that for most part of the last couple of hours. But look at the Nifty bank, now down at the lowest point of the day, about 1% lower. And no, yes, PSU banks are playing a part, but it's not PSU banks that is being the big drag. Let's get the Nifty heat map on the screen, and you will see a clutch of underperformances by the private sector banks as well. So ICICI Bank is down a couple of percentage points. Axis is down a couple of percentage points. HDFC at the far end is down about 1%. Kotak Bank is down about 1% as well. And by and large, if private sector banks fall to the tune of 1%, 1.5%, you would have some bit of drops on the Nifty bank as well. That State Bank of India is down 2.5%, and PNB's sub the 100-point mark is not helping either. Not too many gainers. That's the other bit. Reliance is probably holding fort, but that's about it. Now let's talk about some individual names. Like I was saying, a clutch of these private sector banks have come off. So Axis, ICICI, HDFC Bank, all of these are looking wobbly in the session today. But look at the public sector banks as well, and they've been taken to the cleaners. Be it a Union Bank of India, be it a PNB, which is of course at a 20-month low, but a Union Bank of India, a Bank of India, Canara Bank, all of these have cracked, and cracked meaningfully in the session today. I would suspect that there are some fresh shorts in some of the PSUs as well, even in the session today. There are losers in trade today, the likes of Oberoi Realty, Navneet Education, Chambal Fertilizers, and all of these were stocks that were big gainers in trade yesterday. So you can clearly see that there is profit booking across the board. The sell-on rally template still seems to be there. One stock on which the outperformance continues is Endurance Technologies, but such stocks are few and far in between. By and large, the day belongs to the losers in the banking space. So I must admit that the broader market breadth, Navneet, on the BSE 500 at least I saw, was close to 1:1. So it's not looking abysmal. It's just banks which are being clobbered in the session today.
Neeraj, in fact, the PSU banking space in particular seems to have soured the sentiment in today's session. But let's also tell you the cues from the futures and options space. As Neeraj was highlighting, there were some short positions being taken. I think for Nifty futures, if you could just pull up that intraday, it suggests that there are some fresh shorts which have been taken for the day. Remember, we opened gap up. In fact, we also opened above the 50-day moving average of 10,615 briefly. We traded above that mark, but just, I guess, after the opening session, within half an hour, we gave up those gains, and it suggests from those higher levels there were short positions being taken. Hence, the premium on the Nifty futures seems to have also come down. Well, in terms of volatility, so far, that was a respite for the March series. We've seen the India VIX coming off in the last few sessions. In fact, today, if you see, India VIX has snapped the 4-day losing streak. So that's trading with gains of almost 3.5%. I just want to talk about few option strikes. If you could just pull them up. 10,000 10,600 call as well as the 10,700 call strikes. Both of them have seen aggressive call writing in today's session. Let me tell you, the Nifty PCR in the last two sessions was going higher. The reason for that was there was more put addition which was being seen in the system, but that trend seems to be reversing, at least in today's session. On the put side, however, the maximum addition has been seen for the 10,400 as well as the 10,600 strike. If you look at the range also for the March series, it's pretty large. It's pretty wide, pardon me. 10,000 put is the strike where maximum OI concentration is, and on the call side, it is about 11,000 call. In terms of stock futures in today's session, while Ambuja Cement, a Nifty constituent, remains in focus, it's seen cuts of nearly 5%. Look at the open interest increase, up almost 30%. And the reason we know it, as ACC in this yesterday release has, as of now, put the merger talks with Ambuja on hold, though there is a materials pact of sale and purchase which the companies have signed. But traders have clearly shorted the stock at the opening level. It is not being viewed as a positive sign. Reason being, there were some synergies of almost 900 crore which was supposed to flow through this merger, which will not happen now. The other one is PNB. We cannot get away with this counter. It slipped below the mark of 100 in today's session. The futures traded 97.7. Let me tell you, there is heavy shorting at every level. You can watch it for PNB. 34% higher in terms of the open interest. It's also fallen in very high volume in terms of cash. And Neeraj, the next level, I think, if you look at the options data for PNB, I remember until a week back we were talking about 120 mark, but now it is the 90 put strike which is sitting with maximum open interest. So if that also gets breached, probably we are in for lower levels for PNB.
Yeah, but I think the fall in PNB is not as much technical as it is of disbelief about whether or not what we know about PNB is all there is, and if there is more in store than what. Because let's face it, you know, on Feb 15th, I distinctly remember, and we'd put it out as a tweet as well, when the PNB managers were addressing the media, and they had said that this is the extent of the rot in the system. The question mark was, how is it that they are so sure about it? Since then, PNB has fallen 25% for a stock which had fallen quite considerably. From Feb 15th, when the disclosures were made, PNB has fallen another 25%. It was at 130 on that day. It's at 97 right now. We can always argue, and that's the, I think, the argument that I was having with T.S. Harrier as well the other day. Yep. And always argue that, yes, the stock has fallen so much, go out and buy. You don't know what the book and how bad the book will be. How do you take a bet on this? There will be absence of large buyers in stocks like these.
Right, in the first press conference, I remember they mentioning the total fraud number is 11,400 crore. But I think within 2 weeks, you come up with additional 1,300 crore, and definitely the street's not going to leave you like that. And hence the reason why there's so much of correction that has been seen. And all you know, in the coming days, I don't know if there could be more numbers which would come about either from PNB side or other lenders who may have exposure to this sort of fraud.
So you can always have an argument, and maybe we should have that conversation with Mahantesh Sabarad. He's head of retail research at SBI's Capital Securities, joins us on the show. But the argument always will be, Mahantesh, that yes, at some point of time, there will be some bit of bottom buying that can happen. My question to you is, right now, if somebody is advising or somebody is talking about buying into PNB, is it more a hunch as opposed to an informed decision about what the book and what the numbers are looking like?
Okay, let's look at the book really, and I'll go to the book value of PNB Bank and what it trades like today. So it's probably trading 0.6 multiples on its book value today. Even if you were to discount and say that there is still something in terms of the quality of the book to be written down, there is a certain portion of more frauds or more cases coming up. What the point is that when you already are at 0.6, how low can you go? Therefore, when it comes to really investing in such a stock which has tumbled 25% in 2 odd weeks or 3 odd weeks, it always makes sense to revisit the book numbers, look at the valuation, and then say, okay, the risk is not, the downside risk is probably 0.5 times book, and the upside is quite substantial from here. And mind you, these are public sector banks. There is no dearth of capital coming in from the government for these companies. It's not like a private sector bank who have to worry about where their next capital funding is going to come from. So I would say that with such large falls in the market, it's not a hunch, it's
yeah, but Mahantesh, the capital is not, one, the capital is not coming for free, right? And two, with due respect and your analysis, I hope for the sake of your investors and maybe some viewers who are choosing to buy, turns out to be right. But I've heard this argument when the stock was 120 as well, right? That it's now trading at 0.8 book. How much further can it go down? At some point of time, some of the book will become better and therefore the stock will do well. And it's off around the 15-20% from those levels already.
No, you should have looked at it this way. The book accretion to the book comes from primarily 2 or 3 sources. The first source is, of course, the profits that are plowed back in from the bank. The second is fresh capital that comes into the bank. And third, it's also related to the past NPAs and related to that wherein where you have upgrades coming in, therefore there is an extraordinary profit coming in. I must also add there's a fourth element which is linked to the investment book that you can bring in, and in terms of profits that come into the book value. In all these instances, as far as PNB is concerned, the outlook suggests that the profitability is going to be better, not just for PNB Bank, but for the banking sector as a whole, because you're going to have expansion in credit, that is, credit growth is going to happen. You're going to have expansion in NIMs possibly now. And although the investment book has suffered, you will see that the yields will have hardened too quickly, too fast, and therefore they will correct down, giving some useful profits to the bank. So, and then the fourth, capital is still coming. It is not cheap. I do understand it is not coming cheap, but it's definitely being raised above the current market price, right? So, therefore, from that context, it makes really sense to do a bit of bottom fishing. Of course, you should have certain covered positions here, but it's not a hunch. It probably says that the fall is overdone.
Okay, that's the view on Punjab National Bank, which is one of your top losers in terms of F&O securities. But Mahantesh, let's talk about the themes or the picks that according to you may work out in 2018. And I guess you're pretty bullish in the QSR theme. We've seen the same-store sales growth number from the likes of Jubilant Foodworks as well as Westlife surprising the street in the December quarter. If you could take us through your top picks in this space.
So we have got these 2 companies under coverage, which is both Jubilant Food and Westlife Development. These are not something we claim as having discovered right now. These have been favorites for the markets for quite some time. But the moot point is, why now? And it's precisely because of the recent results that they posted. There was a surprise element in terms of the same-store sales growth that they have given. It's in high double digits, high teens, and that tells you a lot about the prospects of these companies going ahead. Not only are we seeing that the elite affluency growing, that affluent class is growing, and therefore you have these QSR kind of formats penetrating more and more. There is a new trend that is emerging in terms of dining out or having takeaways. So that concept is growing. You have these companies who are professionally very well run, and there is solid backing from their parent companies. I think therefore it makes sense that in a market where we are looking at growth opportunities, the QSR segment is something that comes to mind very quickly.
Okay, so those are the top 2 picks from the QSR space, Jubilant Foodworks as well as Westlife. But Mahantesh, I guess you also like BASF India, where you guys have a buy rating with the target price of 2465. Could you take us through the rationale on this call? I was just looking at the price to book. I think that appears to be around 7 to 8 times.
Yeah, I think from a valuation perspective, the stock appears quite expensive. It's simply because if you look at its financials for the last few odd years, it's surprisingly an MNC which is making losses in India. You don't associate MNCs with losses in India. And what's really happening with BASF is over these years, it has been restructuring its business. some portion of that restructuring has come in because the parent has taken decisions. There are many activities that have happened. So the leather chemical business and the industrial coating business has been sold off by BASF, and it has actually got a new portfolio now in terms of agrochemicals, the herbicide business of Bayer, which BASF globally has acquired. So here is a company which is now emerging from a loss situation to a profit situation, a company which has completed its restructuring, a company whose debt levels are set to rapidly fall down, and you have a growing business now to look forward to. They are into construction chemicals, which is an area which is growing rapidly. They are into TPU, these are, or Celasto, which is a material used for automobiles. And there is a substantial growth out there. There are new plants that BASF put up in these two areas, and you also have agrochemical business growth to look forward to, and that is why despite the valuations looking expensive, this is a company that we likes because of the restructuring led positive changes.
Mahantesh, just shifting focus from your top picks, would you also look to do any sort of bottom fishing for stocks like Ambuja, which has stumbled post ACC's press release yesterday that they've put the merger talks on hold as of now because of some concerns? And if I remember, when this entire restructuring came about, when ACC was supposed to become the whole subsidiary company of Ambuja, they were expecting some sort of synergies to flow into the tune of 900 crore, but actually that's not come into the books in the last 3 to 4 years at all.
I think what needs to be understood is that even then, a few years ago, when this whole merger was mooted, it was not very clear to analysts in terms of how the operations are going to be integrated going forward. And therefore, there was already a skepticism built around the entire merger process. It seemed to be a merger which was facilitating the parents' holdings into India in terms of their restructuring, etc., and not really shareholder friendly at that point in time. Having said that, let's look at the companies individually. They are strong cement companies. ACC, incidentally, a disclaimer here, I own the stock, but ACC is a stock on which we have given a call today. And we think that's because the company is going to see substantial volume growth. If you look at the volume growth that they achieved in 2017, they are a calendar year reporting company. They have 17% growth in volumes, if I'm right, and that growth is going to surge further ahead. They are reaching 80% capacity utilization for all their plants, zero debt company. So and cement is as a space is growing because of the whole activity that we are seeing surrounding infrastructure growth, housing for all, and so on and so forth. So basically, this is probably the best time to look at some of the cement companies. In fact, we would argue and say that the smaller cement companies who have presence in the eastern to the southern part of the country are likely to grow much faster than the other parts of the country. The pricing pressure will ease in south. You will see substantial, or you are already seeing substantial growth happening in the east. The only issue that the companies had was related to costs. Costs are rising, but if pricing improves, the delta can be handled quite well. The cost delta can be handled quite well.
Okay, Mahantesh, I look forward to chatting with you a month or maybe 15 days or maybe 45 days down the line. Hopefully, for the sake of investors in PNB, you turn out to be right. But thanks so much for joining in and sharing those thoughts today. It was interesting having this conversation.
Thank you.
Well, that's Mahantesh Sabarad with his thoughts. Let's see what happens. For now, though, PNB reeling under pressure. In fact, this whole news has taken its toll. I think it's a 2-year low. But Jayesh has done some interesting chart analysis of why maybe this was anticipated as well if you looked at charts carefully. And what does this fall now mean? Jayesh.
So Neeraj, the stock is now trading below the key 100 rupee mark, and also it has declined more than 50% from its recent high of 2017, the October bank recap announcement that was made. So I did a 4-part chart on PNB, and that's the outcome of it. So first let's have a look at a daily chart and how it actually moves on the moving average. So the white line is the 200-day moving average, and this is the recent high that I was talking to you about. That was about 231.6, and it has now plunged below the 200-day moving average, in fact trading anywhere between 30 to 35% below its 200-day moving average, and the last time it did that was early 2016. So the key moving average 200 days, that has been broken. And if you look at in the past, so the last time when it actually did that was in 2014, 15 and 16, a span of about 1.5 years that it spent below the 200-day moving average. In 2014 it slipped below it, and it consolidated for the better part of that year and the next year as well. So you can see that the decline was from about 200 odd levels right up to below 100. So more than 50% being lost over there as well, and then it started climbing back, and then the the journey resumed. You can see that similar instance happened in 2013 as well, when the price actually dipped below the 200-day moving average, and once again we saw a substantial cut over there as well. So the daily chart looking not looking that great, but let's have a look at if the weekly chart shows a different picture. Let's have a look at that as well. This is the interesting one. So what I did was immediately when I looked at this chart, you can see that there is a double top pattern formation. In fact, this high is 231.5, and the recent high that I was pointing out, that is 231.6. so just 10 paisa above the previous high. So that's the double top that has been formed, and post that we saw a steady decline in prices. So once the price starts declining, what you do is look for support levels. So what I did was look at the recent low, which is close to the 130 mark, and the top dotted yellow line, that shows the first support that PNB would look for near the 130 rupee mark, and that also happens to be the 61.8% Fibonacci retracement level as well. We'll get to that as first, but next once this level was breached, which is the next level that you look for, is the next low that PNB had formed, which was below 120 rupees, and the second yellow line shows you that one. That once again has been broken. So now the other support level that you have to watch out for is the double bottom that it formed in 2016, which was below 80 rupees. So currently at about 99 odd rupees. If the double bottom is to be tested, so you can see that there could be further downside for PNB. Now let's have a look at the monthly chart of PNB. What does that tell you? So what I did was just the the recent rally, what it had from 2016 to the high. If I draw a Fibonacci retracement over there, the important 61.8% level was at 131.27 rupees, and that has been broken and the stock has come down. Generally what happens is, I spoke to a few technical analysts, and they say that if this line is breached, then the trend where it started from, that actually gets retested. So that is at about 69.25. If that has to be tested again, we'll have to wait and watch for that. As far as the valuations are concerned, let's have a look at how the valuations plan out. So this is a chart of the PNB's price to book versus the estimate price to book. So the price to book is the white line, and the blue line is actually the estimate price to book, and you can see that there has been a sharp fall. So this is a quarterly chart for 10 years, and you can see that PNB now trades at about less than 0.5, and it actually has an estimate of about 0.5. So trading on the expensive side as far as forward valuations are concerned.
All right, Jayesh, thanks a lot for bringing that interesting piece of technical analysis for Punjab National Bank, a counter which has been hammered in the recent past. And just to remind our viewers, when the recapitalization news came about, and in fact Jayesh highlighted in his charts as well, that time on a single day you saw the stock of Punjab National Bank going up by almost 50%, and from those highs now the stock stumbled. Actually it's corrected nearly 50% if you look at it, at least for since the time that news of the Nirav Modi fraud came about. So currently, it is one of the top losers as well, and it has also taken the other PSU banking stocks lower with it. So if you look at today's session, you've got stocks like Union Bank, Bank of Baroda, and not to forget, of late, a lot of Funda as well as the technical analysts were turning bullish on IDBI Bank, and we've actually seen that counter going up in the recent past. But today, even IDBI Bank has succumbed to some bit of pressure as it is trading with cuts of nearly closer to 7%. Well, that's about the PSU banking space, but let's move ahead and put spotlight on Astral Poly. The stock has gained almost 15% in the last 3 trading sessions. Let's go across to Neeraj to find out some analysis that he's done courtesy the Bloomberg terminal. Neeraj.
Hey, so one simple thing, just want to show the trade pattern, but before that, just thought would try and dig out why is it that brokerages would be bullish. So I found out one note which is from Investec, and the reason I brought that up is because one, the stock is up and active today, and they say that the long-term story is intact. They expect a very strong Q4. Now, that's good news if indeed a company comes out with a very strong Q4 post what was arguably a fairly decent Q3 as well. In Q3, in the interaction with Bloomberg Quint, Astral had mentioned that they're focusing on price, and that's a very important thing. And you know, the one good thing for Astral, as I looked at the con call as well, is that they have mentioned explicitly that the capex is over and enhanced capacity to the tune of 25% growth in capacity. That enhanced capacity comes on stream from June 2018. So that only adds to whatever growth, a growth which could be meaty in nature coming out in FY19 as well. Investec's price target is about 975. But the consensus price target is slightly lower than what the current market price is. And if you look at the graphic dashboard of Astral Poly, it will come up on your screen. You will see that the consensus target price is about 832, and even that is at a substantial premium to peers. So keep in mind, Astral anyways trades at a very, very hefty premium to almost any of these peers. But maybe the quality or otherwise all finding favor, which is why in today's session as well, some substantial uptick in volumes, so some great cash market volumes that we're seeing in the session today. Be interesting to see the kind of delivery volumes that we get to see in Astral today. Just in today's session, seems to be a frenzy of buying. Navneet.
Well, that's right, Neeraj. In fact, we've seen a good run-up coming in for this counter in today's session. That's Astral Poly for you, doing well. But besides that, there are a couple of stocks from the broader markets which have seen a good bit of surge. Not today, in the recent past. Just pull up D-Mart. That's trading with gains of nearly 3%. Remember, last week, Goldman Sachs had upgraded the target price to almost 1671. So Avenue Supermarts today is trading with gains of almost 3%. And besides that, you've also got stocks like NCC, IRB, which are your top F&O securities also for the day. From the broader markets, I was just observing stocks like Zuari Global. That's seen a good trading session. You've also got stocks like HEG and Graphite, both of them, despite valuation concerns. And these are your multi-baggers of last 1 year. But today, there's been a stupendous run-up for both these stocks. And Graphite is actually locked in upper circuit with gains of nearly 5%.
Okay, before we move any further and get our guests, let's talk about a news break or something that we're learning. The JSW Group and Aeon Capital Partners combined is the only bidder in the case of Monnet Ispat. Not unknown, but it's one of the 12 largest stressed loan accounts referred for insolvency last year. Sources have told Bloomberg Quint that the Committee of Creditors have accepted the revival plan submitted by the combine, which proposes to pump in 3,700 crores in Monnet Ispat. Paswini Upadhyay has the details. Paswini, fill us in.
Sure. The 37,700 crore rupees will be brought in by a consortium of JSW Steel and Aeon Capital Partners. And in the consortium, Aeon Capital Partners will be the lead partner with 69% shareholding. Here's how the bidders, intend to or have proposed to utilize the funds. Out of the 3,700 crores, the proposal is to pay 2,650 crores to the financial creditors. Remember, the admitted claim is a little over 10,000 crores. So the lenders or the financial creditors in this case are taking a 76% haircut. The remaining 1,055 crore rupees will be allocated towards capital expenditure, working capital and transaction related expenses. Interestingly, the operational creditors, their claims worth at least 443 crore rupees were admitted, but they are set to get nothing if the proposal, is approved in this current shape and form. Let's come to how these bidders are intending to source this 3,700 crore number. They are expected to take loans from banks to the tune of 2,500 crore rupees. There will be a working capital advance by JSW Steel to the tune of 125 crore rupees. There will be funds by bidders in the form of equity and quasi-equity, and the number to that is 875 crore rupees. And the bidders will also bring in additional debt and or equity at a later stage to the tune of 200 crore rupees. In the equity and quasi-equity, the number can be further broken down. Remember, we had the 875 crore rupee number. This includes 398 crore as equity, 277 crore via compulsorily convertible preference shares, and 200 crores will go to certain existing lenders that are currently holding optionally convertible preference shares. Here is how the shareholding will change if the resolution plan is approved by the Committee of Creditors in this current shape and form. JSW Aeon will hold 75% stake in the company. Lenders will hold 18%, and the incumbent promoter shareholding will be reduced to 3.16%. Currently, the promoter group holds 25% and financial institutions hold a 50% stake in the company. There's another plan that the JSW Aeon consortium has proposed, which is to transfer certain non-core assets of Monnet Ispat into a new company and probably sell it at a later stage. Some of the potential assets that could be a part of this new company include the company's Raipur unit. There is the Hahadidi iron ore mine, in its investment in Orissa Sponge Iron Steel, its corporate office, coal washery at Patirdi and Angul, along with certain non-core investments. Two limestone mines in Chhattisgarh, which is the Gayatri and Goma Pasuri limestone mine, are proposed to be continued in Monnet Ispat for the benefit of JSW and Aeon.
All right, Paismi, thanks a lot for bringing all those exclusive details where JSW combined with Aeon have bid for Monnet Ispat. That's some exclusive details coming in for you. But let's switch focus back to the markets. Nifty is trading around the mark of 10,550 as we speak. Bank Nifty is the one which is under pressure, and that's precisely owing to the PSU banking space. The Nifty Bank currently trades with cuts of almost 1%. Good time to get in our technical experts on board. Ruchit, Jain, Technical Analysis at Angel Broking is joining us on the show, and we've also got Sacchitanand Uttekar, AVP of Technicals at Trade Bulls, joins us. So good afternoon to both of you, and appreciate you joining us today. Sacchitanand, let me come to you. The sort of correction that one saw from the opening levels, we did have a mild bit of gap up opening. Then we've corrected from those levels. In fact, we did breach the 50-day moving average quite briefly. Has the trend changed, keeping in mind the rally that one saw in the last two sessions?
Well, good afternoon. As you rightly said, Indian markets are under pressure, and thanks to the domestic cues which are there, purely based on the PSU names which are dragging the market. But if you look at the overall setup, I think the markets are just in sync with the global trend. And if you look at the overall structure in the Indian markets right now, the higher top, higher bottom structure, even on the intraday scale, is still intact. So we are of the opinion that until unless we don't see a closing below, say, 10,520 on the lower side on Nifty, the trajectory could stay on the higher side. We are expecting that markets could rally right up to, say, 10,690 in the coming trading sessions, and that's why this decline that we are seeing right now looks like a very good opportunity, and one should continue to hold on to the long positions with a price expectation of around 10,690 to be witnessed in a couple of trading sessions from here on.
Ruchit, what about you? Do you concur with Sacchitanand's view of holding on to the long positions?
Hi, good afternoon. Well, I have some different view over here, because if we see technically, then if we just see the entire month of February, then the first week of February was more of a price correction in the Nifty index, where we saw from 11,200 levels the index corrected right up to 10,300 levels. But after that last couple of weeks, it has panned out to be more of a sideways consolidation phase, which we usually term as a time correction. So I think within this time correction, if you see entire last 2 or 3 weeks, the market have consolidated in the range of 10,300 on the lower side and 10,640 on the higher side. So from lower end of the range post expiry last week, we have now already moved up to the higher end of the range. And even in today's trading session, we see that 10,640 has not been able to cross. So from a very short term perspective, we are advising to book profits on the long positions at the higher end when the market comes around 10,600, 640 range. That's what we had seen in today's morning trading session. Now, it's not the market would correct immediately from current levels. The most probably the range that will pan out for next 1 or 2 trading sessions would be 10,500 on the lower side, which is a support as per the gap theory of yesterday's gap up opening, and 10,640, which is the higher end of the consolidation phase. So we are expecting the markets to consolidate in this range of 10,500 to 10,640 for next 1 or 2 trading session. So traders should look for a stock specific momentum over here. I think there should be an opportunity to trade on both the sides. On short side as well, we are seeing a weakness in PSU banking space, which is likely to continue, whereas some of the mid cap spaces we could see some positive momentum. So 10,500 to 640 is what we think that the markets would consolidate in this range for next 1 or 2 trading sessions.
Okay, let's pick on specific stocks. Sacchitanand, I'll come to you first. Any ideas that you would want to share with our viewers?
Well, we have a couple of ideas both on long as well as short side. So first one is Jubilant Foods. So if you look at the overall structure, 1950 has been acting as a very good support. The correction that we saw recently got restricted towards this particular support itself, and there's a very good rebound that we are seeing right now. If you look at the momentum averages, the convergence is indicating that there's a momentum in the offing. So we are expecting a price target somewhere close to 2180, which could be seen in next couple of trading sessions. So on a momentum basis, a stop loss can be placed somewhere close to 2000 and long positions can be initiated. The second call is a sell call on SBI. If you look at the overall structure, the structure continues to be weak. We have fresh evidence of a breakdown from a rising wedge on the intraday scale, which is indicating that the stock could revisit the lows somewhere close to 260, and short positions can be initiated right now. 270 to 271 could be an ideal level. 276.30 is the stop loss that we are recommending, and we are expecting that this particular drag that we are seeing in SBI could extend further.
Okay. Watch out for these stocks. Thanks for that, Sacchitanand. And Ruchit, your ideas for the afternoon, just a quick mention. Very good call on persistent, Ruchit. What does somebody do there?
Thanks a lot, Neeraj. I think the long portion should be held on over here just because we have seen some good outperformance in the stock. Last 2-3 trading sessions, in spite of not large cap IT stocks, have not shown significant movement. But persistent has definitely given a breakout, and it has also attracted very good volumes. I think this stock should head higher towards 900, where one can look to book profits. Now, as far as fresh stocks, the fresh buying or selling is concerned, I have a buy recommendation in Bharti Airtel over here. We have seen that on the monthly chart, the stock is trading around its support level. Just in the month of October, November, we are talking about a breakout from 8 years of consolidation phase in Bharti Airtel. Along with the markets, the prices have corrected in last 2-3 weeks, and again prices are trading near that breakout levels, and then the risk reward ratio is quite favorable to go long over here. One can go long for a short term. One can keep stop loss below 402 for target of 460. But Neeraj, I think if one can hold for 3 to 4 months, then we have a target projection around 570 rupees for next 3 to 4 months perspective. So the risk reward is very much favorable for short term trading as well as for positional perspective in Bharti Airtel at current levels.
I wonder why would that be the case, though. I mean, not doubting your chart capabilities, just trying to think fundamentally. But Ruchit, Sacchitanand, stay on. So much more to talk about, gentlemen. Let me get in our fundamental expert on the show as well, Nipun Mehta. He joins us right now on the show. Nipun, we just had a really extensive chat on banks. Won't dwell too much into PNB, but just wondering, PNB notwithstanding, would it be a prudent idea to get into, say, State Bank of India for that matter? It's a PSU stock, unlike some of the others, but has suffered a lot in the recent wake of the PNB fraud. sentiment as well. What does one do here with SBI? Because frankly, I don't want to get into a stock specific discussion, but when it comes to buying a PSU bank, it's probably the only one that I can think of.
Sure. Good afternoon, Neeraj.
Good afternoon.
Yeah, I think I would tend to agree that yes, if there is any one PSU stock that could be there, that could possibly be SBI. But when you look at the entire pack, I think clearly it's not in a hurry that you're going to see any up move that's going to come about. I think that apprehension that there could be more skeletons in the cupboard is something that's going to ensure that there isn't going to be too much of either of institutional or retail buying that's going to happen, at least as far as the short term is concerned. You've already seen one fresh announcement come in for an additional provision that might need to be made. There will always be fears on further such announcements coming in from other banks as well. I think there are the risk-reward ratios is not too favorable. I think there are too many other options that are there when you compare it with looking at these kind of. There could always be an argument that the valuations are attractive, but our sense is that there are several other sectors where valuations could be attractive and which could be far safer in terms of medium to longer term investment in comparison to a lot of these PSU banks.
Okay. And we've not seen actually, Neeraj, any institutional selling in the stock of PNB despite of the kind of correction. Remember, 2 weeks back we also had LIC coming about, and they did mention that they are not looking to hive off their stake. They still maintain about 13 to 14% stake in the company. But Nipun, we've already discussed banks in details. Markets, they seem to be jittery. In fact, the start of the year was pretty good, but in the month of February, we did see some selling pressure continuing till now, at least from the FI end. What is your reading been of the market? Would you look to now start identifying stocks which have corrected to buy, or would you wait for more correction?
Well, I think clearly FI selling is something that's acted as tremendous pressure as far as markets are concerned. You've seen a lot of large caps correcting significantly, constant selling by FIs across last month or thereabouts, or even longer. I think that's something that's expected to continue for some more time. In fact, I'd be surprised if there is a significant positive FI figure for calendar year 2018. If one looks at alternative opportunities that they have, I think very clearly some of the developed markets are really clearly outperforming. The obvious comfort level that is there for investing in a lot of these developed markets is significantly higher in comparison to the emerging markets, where and particularly where they would perceive higher risks in markets like India, when you have these kind of banking issues that keep coming by. But also the kind of continuous provisioning that you've seen as far as the banking sector is concerned. But having said that, I think to answer the second part of your question, I think very clearly this kind of a fall is an opportunity where a lot of the mid caps have corrected much more than what the markets have corrected, in the fear that there could be significant. There has been some profit booking that has happened. A lot of these mid caps have come out with excellent December quarter results, and again a very positive and optimistic management commentary for the subsequent quarters. A lot of them are expanding. A lot of their balance sheets are becoming stronger as cash flows improve. So our sense is, yes, this kind of a fall, this kind of a correction is definitely an opportunity for very selective buying in the mid caps.
Okay. Well, selective buying in the mid caps, but pick and choose your battles wisely. I think that's what probably every investor and trader worth his salt would tell you. Banks have really taken it on the chin today. What's also decelerating the last couple of days is Sun Pharma. It probably had a decent Friday, but the last 2 days, or the first 2 days of this current week, Sun Pharma is seeing fair amount of profit booking. It was down yesterday, down today. I would reckon Sun Pharma Advanced Research probably meeting the same fate as well. We don't quite know the decisions out here, Nipun, but the observations have come off a bit. The perceived valuations might be okay, but on Friday we were just taking a stock check of what the numbers would be looking like. Sun Pharma still trades at about 25 times 1 year forward earnings. So for a company to be in a sector which is not exactly gung-ho, 25 times I thought wasn't cheap. What do you do here with Sun Pharma, Spark, or maybe any of the other large cap pharma names?
Well, I think very clearly the apprehensions that were there, the concerns that were there as far as large cap pharma from US FDA are gradually waning. They're not completely out of the way. Yes, number of observations have reduced for in a lot of these cases. A lot of them have got approvals for a lot of their facilities, which were earlier under question. So I think that concern has definitely waned. Having said that, I think the markets are not necessarily going to start factoring that in, except in cases like, as you mentioned, Sun Pharma, where still, despite the concerns, the valuation do seem to be at 25 times, do seem to be steep. But when one looks at, the historical valuations that used to be there for a lot of these large cap pharma companies, some of these current valuations do look, I wouldn't say cheap at all, but at least reasonable. And until there is that concern that goes away in terms of US FDA, till there is that realignment of businesses that happens in a lot of these cases where these concerns completely wane, you aren't going to see any re-rating that's likely to happen. You might just see gradual buying that could happen from institutions. But when there are alternative opportunities in mid-cap pharma, our sense is the large cap pharma is going to have a slow upward trajectory. It could just underperform the markets. But suffice it to say that probably the worst, as far as large cap pharma is concerned, is probably over.
Nipun, besides pharma, the other export-oriented sector, IT, at least the numbers in the December quarters, they didn't disappoint. There were no negative surprises, so to say. And off late, the rally that one has seen in a couple of the mid-cap IT stock, right from Mindtree to Persistent, what have you made of it? Do valuations at these levels attract you to make fresh investment either in large cap or mid-cap?
Well, as I've said earlier as well, I think 6 months back, IT was a contrarian bet. Today, with improved results, better alignment of their businesses, I think a lot of these large cap IT companies as well are showing reasonable amount of profit. If you look at a reasonable amount of promise, I think if you look at the NASSCOM projections, they've been reasonably positive. At least there is a clear projection of turnaround as far as even large cap IT is concerned. Visa concerns do remain for some of them. That probably has increased costs in certain cases. But I think very clearly there has been that readjustment that some of these companies have done. And the focus is more on the products as opposed to just the visa issues that are there. So whenever it comes to IT allocation, I think we've seen greater IT allocation happening as far as mid-cap ITs is concerned. You've seen outperformance as well. But our sense is gradually you could see incremental allocations coming in for large cap IT as well. Not necessarily in a hurry, but you're very clearly seeing that incremental IT allocation coming in for the large cap IT. And that's something that could continue gradually during calendar year 2018.
Okay, Ruchit, Sacchitanand, Nipun, just stay on, gentlemen, for a moment. Remember, the stock of Ahluwalia contracts was in focus yesterday. It was the pick of the week from HDFC Securities. And the stock gained a lot in trade yesterday. Today, I think a clutch of these gainers have come off. Not blaming it. 390, down about 1% marginally. But HDFC has mentioned this stock as the pick of the week. They believe the revenue visibility and the strong order book position should hold the company in good stead. The margins and the return ratios all look okay, and the conservative nature of management brings down risk levels and could lead to a re-rating of the stock. Their valuation and target multiples are substantially higher. But let's get in the management to talk about that. Shobhit Uppal, Deputy MD of Ahluwalia Contracts, joins us right now on the show. Good having you, Shobhit. Thanks so much for taking the time out. How has business been shaping up? I think the analyst community perceives you to be a bit conservative. I'm guessing that probably will be reflecting in the way your numbers and your growth books have grown with the kind of returns that you'll be getting on your orders as well. How is business shaping up right now?
So the prospects look good, conservative, that's by design because, we've been through a recessionary phase. You know, there are 3 or 4 large companies like ourselves who've gone through this phase, and we don't, whatever lessons we've learned through, we don't want to be profligate now that, the business is looking up. The public sector spending has been there, which we've reaped the benefit of. Now we see green shoots of revival also on the private sector. You know, today our order book, 40% comes from the private sector, 60% from the public sector. In the long term, we aim to make it even, 50-50. We are seeing private spend in the education sector, in the healthcare sector, government also, these 2 sectors are booming. So yes, we are in line to meet our targets this financial year. We are growing for the 9 months we have grown at about 14%, and our PAT margin has grown at about 7%. So that's what our target was for this year. Our top line should also grow anywhere between 15 to 20%. So the prospects are looking good.
Mr. Rupal, if you could talk to us a bit on your order book, how is that looking like? And also if you could give us a breakup of that order book, how much of it has come in from the private sector and how much of it is from the government side?
Our order book as of 31st December 2017 stood at about 3,600 crores. Our new order inflow in the 9 months or 10 months of this financial year has been to the tune of about 1,300 crores. As things stand today, we are L1 in orders worth about 1,300 crores. So we have far exceeded the target that we set for ourselves. The next year's target is about 1,600 crores to 2,000 crores, which should not be a problem. As was mentioned earlier, that we are conservative in nature. The order pipeline is good, but we don't want to grow too fast. In the short term, there is an increased competitive intensity. We don't want to fall in the trap of growing too fast or picking up orders, which are fixed price contracts or where the margins are low. So that is why we are conservative. The promoters are hands-on. We want to consolidate in the geographies that we are present in. We don't want to go into the hinterland and spread ourselves too thin. As far as the private and the public sector goes, as I mentioned earlier, till about 2 years ago, 80% of our order book came from the public sector. But we want to kind of hedge our bets. We see the private sector reviving. So we've slowly brought down the exposure to the public sector. Today it is at 60-40. And over the next 1 year, we aim to make it even at about 50-50.
In fact, I was just coming to the private sector. Private capex, Mr. Rupal, has been a concern for the last decade, so to say. Any new orders from the private sector that you've bid for, or are you expecting in the coming quarters?
Look, we have long-standing relationships with some marquee clients in the private sector side. On the private sector, it's largely relationship-driven. So Amity, on a pan-India basis, is a blue-chip client for us. We do all their projects. Bennett, has forayed into education. We do their projects as well. We are seeing green shoots of revival on the commercial side. Brookfield is a client of ours. They are extending further orders and they are going with us as contractors. So we are seeing on the commercial side and education side especially, we are seeing increased spend happening. As far as the residential goes, that continues to be slow. And maybe it will take another year or so for the residential sector on the private side to revive. But we are seeing enough orders coming in from the commercial and education, as I said earlier.
Mr. Rupal, before I let you go, just one more question. What's the kind of margins that you get from the private sector vis-a-vis the government side? Because I do understand the payment terms of the orders you get from the government is better than what is prevalent in the private sector.
Look, that's a factor of the situation that the industry finds itself in. Historically, private sector has always been a better paymaster. And when the going is good, when there is no liquidity crunch, the rates are better and payments are always better on the private sector side. It's only during the downturn when the private sector virtually was in a coma that we started focusing on the government sector, and a lot of other peers of ours also followed suit. But private sector, the contracts are not as rigid. There is greater flexibility. Government contracts are rigid, and also they are bound by the L1. They are bound to award the contract to the lowest bidder. In the private sector side, as I mentioned, it's always the relationship which counts when the contract is awarded.
All right, Mr. Rupal, we'll let you go on that note. Appreciate you joining us today and giving us that heads up as to what's happening with Ahluwalia contracts, as it was the pick from HDFC Securities. And just to highlight what you mentioned, their current book is nearly 3,600 crore, and going ahead, they will be focusing more on the private side. They look to get the ratio of almost 50:50 with regard to orders from the private as well as the government side, and the kind of growth target that they've highlighted is nearly between 10 to 15%. That's Ahluwalia contract. The stock was up yesterday, so a bit of profit booking seen in today's session, down 2%, but in last 1 year, the stock's only up nearly 25%. Well, it's time for us to slip into a short break here in this edition of Countdown. Don't go anywhere. On the other side, we'll get you the Fab 4 stocks of the day at 3:15 p.m. We also tell you what the dealing rooms are recommending, and obviously closing strategies from our technical experts. Stay tuned.